Hello, everyone, and good evening. This is Simon Mishevich from Optimised Accountants, and I'm now going to go through our session on UK property tax updates. And this is, of course, before the Labour Party announces their budget. So there will be things that will come out, which I've done quite a few videos already about. So feel free to go into those videos. But let's kick off from today anyway. So my name is indeed Simon Mishevich. I'm a UK US qualified tax advisor. And I'm here to try and help you build your wealth whilst reducing your tax liabilities. And today, of course, we're talking about real estate property and making money from real estate as much as you can without the taxation. There are other channels that we have created, so feel free to get your phones out and get your camera and use a QR code, or you can just use the @ sign to find those out. So obviously we're in the middle there, UK property tax accountants, but we do have expat international tax as well. Small channel, it's only just started, and we've got moving to Marbella, Spain, which is what my wife Louise and I have done. We have moved to Spain to get away from the weather and the high taxes that Labour will be introducing. So anyone else who wants to move to better islands, then feel free to look at that channel too, and we can help you move to Spain. This doesn't really make much difference, but one thing I would say, microphone's muted while you're not on Zoom with me, so that's okay. But ask questions at regular intervals. That would be really good, and then I can certainly answer those, and I will pause them. So as we're going along, it would be great if you can start typing your questions in, and at certain intervals, I will answer those questions in those slots. Okay. And if you then got follow-up questions, don't worry, I will pick that up in the following slot as well. Ask and you shall receive. Please do not be passive. I want you to be as much engaged in this as much as possible. So if you're not quite sure what I have said or what I have meant, then just even a clarification question is totally acceptable. In fact, it's wanted because I want you to get as much out of this session as possible. And one of the things I did was a video which you can look yourself, which is Labour's 2024 manifesto, more stamp duty. And I talked about the different implications of what they'll be bringing in. So feel free to have a look at that video. Obviously, there is a Labour Party manifesto 2024, and that is where I've got all my information from. Feel free to also just Google that, because that'll be an interesting read, and you'll kind of get an idea of where the Labour Party will be moving towards. It won't give you the answers for October, of course. No one has those answers, but it gives you a clear picture of what the Labour Party are doing. I will be moving to between my screens simply because I want to make sure that if there are any questions that I can see those. So I'm just going to say hi. And if people are watching this, feel free to just type that a reply back to me to say hi. That'd be much appreciated. And if you can give a thumbs up if you're enjoying this session, that's even better for me. Okay, begging over. Let's go into Labour Party tax at tax. There is, of course, going to be capital gains tax impact. We don't know what that is right now. I've done a video about that as well. Feel free to go on our Optimised Accountants channel to see this. But that video talked about could it move to income tax, and I justified why it might go to income tax based on other countries, which of course HMRC will always benchmark other countries. There is of course a mooted point about wealth tax, whether they will bring it in or not. It's certainly an avenue that Labour Party will go through. Whether it's wealth tax or inheritance tax, that's something that is debatable, but they'll go for one. My view is that inheritance tax, there isn't much to go at, where wealth tax is an annual payment, which other countries have started to introduce. So you'll get more revenue, or HMRC will get more revenue from a wealth tax than they would inheritance tax. So I'd be quite surprised if they didn't do something with that and then brought in inheritance tax instead, or changed it. And of course, stamp duty land tax, such as I think the first time home buyer was going to be reduced quite significantly, which will impact a lot of people that are buying property in London. And it's an introductory rate for foreigners. There's obviously called one for foreign surcharge of 2%, but they're going to increase that, I believe, to 3%. So if you are foreign looking to buy UK property, it is about to get more expensive. And they may have a whole change in terms of stamp duty land tax as well going forward. So all will be announced, of course, in October. What I want to do now, though, is give you an idea of stamp duty land tax, and it's not just you can attend these sessions and you just find the basics, all the things that you already know. So I purposely have put in sections that affect property investors, landlords, and at the end of each module, I've put in ways to reduce that element of tax. So here we talk about stamp duty land tax. So please do stay until the end of this module, because we will go through how to mitigate it. So first of all, there's the stamp duty land tax, which is based on a banded rate for residential property. And residential property sounds obvious, but I think it's worth just highlighting what it is. It's houses and flats. FHL, service accommodation. People think that that is a business and therefore is not residential property. But what people need to realize is that residential property means that you're staying over for the evening, as in sleeping there, and that makes it residential, which is what you do with FHL and service accommodation. And for less than 6 houses. Now, that's an interesting one, and I will come back to that about why 6 properties, what's so significant about that. Please do stay tuned, though, for that. And then there's another banded rate for non-residential property. By the way, if you see these QR codes on the right-hand side, they are useful. This one is talking about best currency conversions. So if you are moving countries, I deal with a lot of international clients, and I often find that I, like them, I've often used my banks, or I have used really dodgy conversion websites, which means that I'll pay high conversion costs and don't get much out of it. But there is a great QR code for a company that does the best conversion rates, in my opinion. Well, not my opinion, I've actually checked that out. So feel free, if you're going on holiday or if you're doing business internationally, definitely use that QR code. So non-residential rates of stamp duty land tax, we will talk about rates as well, what they are shortly. But what are non-residential? Well, non-residential really means commercial. So commercial property in this regard is offices, shops and warehouses, uninhabitable residential properties. So if you can't live there, there have been a lot of cases, by the way, where judges are now getting a bit clued up about people trying to rip out bathrooms or water facilities just to make it uninhabitable, and now they're just throwing them out of court. So if you do get a property that is light touch uninhabitable, as in you could do some cosmetics to turn things back on to make it habitable, then those cases then now being thrown out in court. And I've done quite a few videos of that as well, so feel free to go on to our YouTube channel, talk about uninhabitable properties, and you'll get a bunch of case law that I've done recently. And then 6 or more properties. Now, this is the thing I want to talk about. If you buy from the same seller 6 properties or more, then those transactions become non-residential, as in commercial. That's really important to know, because people would have known that MDR, multiple dwellings relief, whereby you buy 3 or 4 properties or something like that, and you can take the average value of those properties to give yourself the new rate for multiple dwellings relief. Obviously, that is now gone, but what hasn't gone is the 6 properties or more, and that is still non-residential rates. So if you're in a fortunate position to buy a block of flats of 6 units, then that would come under non-residential properties. So really, that could be a motive for you to look for people that are selling blocks as opposed to just a house. And you can find them with bed sits as well. So do stay really alert when you're looking at Zoopla or Rightmove. that you can really find a lot of these properties about, actually. Okay, so let's have a look at residential or non-residential rates. And you'll notice there I've got one band rate of 0%. For residential, you get a 0% up to £250,000. And then you've got and this is just the banded rate. So we'll talk about other types of issues with stamp duty and land tax shortly. But then you've got non-residential as well. And there's a 0% rate for properties up to £150,000 on commercial properties, or non-residential is the right term. Then there's band 2, which is then from £250,000 to £925,000. You pay 5% for residential. And then on non-residential, you pay 2% from £150,000 to £250,000. There's a band 3, which is the 10% rate from £925,000 to £1.5 million for residential property. And it's a banded rate, so you're not taking the full amount. So if you're buying a property for £1 million, you're not looking at the 10%. You're just going through the levels, and then you have to do a calculation on that. And stay tuned, because I can help you with that as well. And then there's the 5% for the non-residential properties when you're buying properties for £250,000 or more. And then finally, you do have a band 4 for residential properties, which is 12% on anything over 1.5 million. In addition to the banded rates that we talked about, there is, of course, the 3% stamp duty land tax rate as well. And I'll talk about what they are. So these are rates already discussed. So there's the banded rates, but then we've got 3% on second properties in your own name. So if you're buying a buy-to-let property and you have a home, for instance, then your buy-to-let property investment, which is the second property in your name, you would incur the additional 3% stamp duty land tax. And that's on the full value. And that's also in addition to the banded rate. So there's going to be 2 charges in this regard. If you're buying properties inside of a limited company, which is another debate for another day, but most people now invest buy-to-let properties inside of a limited company, then there is a 3% automatic surcharge that will apply to that. So there's the banded rate plus the 3% rate as well. In addition, there is the 2% surcharge for foreign investors that want to buy properties in their own name. And if foreigners own 51% or more of a UK limited company, they will also pay the 2%. So there's 3 bands for foreigners. There's the banded rate, normal rates that we discussed, 3% plus the 2%, which, let's not forget, it's in the ether that Labour Party will change this 2% rate to a 3% rate. So as I said, I did want to go through this. And if you have questions about what I have just gone through, then please do feel free to type those away, and I will come back to you with answers. Let's look at now what I promised, which is ways to save stamp duty to land tax. Hopefully some people will say, well, I know all this, which is great, because that just tells you how much of an expert you are in this field, and you probably are going to save yourself a lot of money. But a lot of people may not know. So first thing is buy commercial. Whenever I speak to property investors, they typically talk about residential property. Why not buy commercial? Commercial could be storage. You know, everyone wants storage nowadays, don't they? Or if you've got land that you do grazing on, or farming or something like that, then that could also be commercial. There are going to be a lot more in terms of the government using ports for infrastructure. And again, there is a lot of that for warehousing that people will need to use or rent. So that could be another option for you. One other option, which a lot of our clients cleverly do, is they will buy commercial property because it's cheaper on stamp duty land tax. They're avoiding the 3% rate. They're avoiding the 2% foreign surcharge as well if they're foreigners. And they will buy commercial property and then convert it into residential. So they're only paying the banded rate on the non-residential rate. So it saves a significant amount of stamp duty land tax. In addition, whenever you're buying a commercial building and then refurbishing it to convert it to a residential, you could reduce VAT on those works from 20% down to 5%. And then we've worked a nice mechanism to even reclaim back the 5% as well. So you could have a much lower stamp duty, land tax, and VAT at 0% for the total refurbishment. And that's something that a lot of our clients will do. It's very much a lot more complicated, so I certainly won't be going through that detail in this video. Buy uninhabitable properties. Of course, I did talk about case law going through where lots of people are trying to buy properties with missing bathrooms or kitchens, but the courts are now getting quite used to this as a strategy to ask the seller to rip things out before they buy it. And that makes them uninhabitable. But actually what they're saying is, well, cosmetically, you could just put in a pipe and get water to work, or put in a new bathroom, and you've therefore got washing facilities. And oh, by the way, if you're missing a kitchen, then just put a kitchen in. That's cosmetic. You're likely to do that anyway. So what's the difference? And so those kind of courts cases are going against the taxpayer. List chattels. This is not something that I talk about too much, but it's something that no one really talks about. And that chattels is the things that go in the property. So if you're buying the furniture, things like carpets, curtains, freestanding machinery, fridges, cookers, if it's freestanding rather than integrated into the house. If you're buying the sofas, TVs, and that kind of thing, what you could do is identify those as chattels. And chattels is not chargeable for stamp duty land tax. So only the bricks and mortar is. So you can really go to town with it. And people say, well, does it affect my mortgage? Not really, because the mortgage is already been agreed. This is done on completion, whereby they're doing the calculation for stamp duty land tax, and therefore it doesn't really affect what you are going to get with a mortgage. So chattels is a very good way of reducing stamp duty land tax. And if you're buying a property and the chattels therefore are £10,000, well, 3% of that is the 3% surcharge plus the banded rate. You might fall and save £1,000. It doesn't sound like a lot, but it certainly can help you to save some money. And sell your home to a company. Another clever strategy here, which involves, if you're buying a buy-to-let property in your name, you may have a home, or you want to buy a second home and you want to rent out your first home. Now you've got two properties in your name. And one of the ways you could mitigate stamp duty to land tax is to say, well, actually, for my home example, I'm going to sell my current home into the limited company, and then that could be rented out from there, which is good because it helps you reduce tax, especially if you don't need the money straight away. And it helps you to lower the stamp duty to land tax, the 3% on the new home. So this is really quite a clever strategy for people that are upscaling. So if you're buying a property for £1 million and your current home is £500,000, then you don't want to be paying 3% on the million, which would be the second property. You want to dispose of the £500,000 property, and you can easily do that inside your limited company. Again, we've worked with so many people to do that. Everything I talk about, by the way, you're never going to see me talk about things that are a little bit shady, and you see less tax for landlords and now got this Spotlight 63 against them. I'm going to say that because there are some dodgy stuff out there, offshore loans and filmmaker loans and whatever else, IR35 scams. They hurt you eventually. It's not the promoters of these schemes. They just close down and you're left with a burning issue. So you'll never see me do anything like that. I always think that there's plenty of money to be saved just using the legislation that's right in front of us. We don't need to do some over elaborate, clever stuff. We just need to communicate to people like you good selves watching on this to see how you can save stamp duty to land tax. And these are 5 different options that you can do. And there is on our website, interesting enough, stamp duty to land tax residential calculator. There's also a stamp duty to land tax calculator for commercial, non-residential properties as well. So head over to our website and you will see that there is a calculator that you can use. Okay, this is the Q&A session, so time for a guzzle of Diet Coke. This is Diet Coke, by the way, even though it's red. So let's have a look at what your questions are, and then I can head off to the next subject. So Ro has said hi. So hi, nice to see you, Ro. I'm going to try and see if I can share this every time I do it. So let me just see. Okay, so let me just share this with you. Hopefully everyone can see it. So this is a question that's come through from Alex saying, hi there, could you please talk a little about the benefits and ease of setting up a limited company to declare income from short-term Airbnb rather than declaring as part of your income tax? And to be honest, it's not anything more difficult than setting up a company. You know, you can set up a company wrongly yourself within a day. You could buy an off-shelf company, which is already in existence. I wouldn't advise that. I would always say work with a specialist to set up a new company, and make sure that you set it with 2 different people with alphabet shares, that kind of thing. So quite complex area, but I think working with a specialist, you can certainly get us to set up a company for you for £500. Sounds like a lot, I know. But the idea behind it is we want to show you what the benefits are for using a limited company, what share structures you should have in place for you and your family, and then how to extract money as well. So we give you a nice PDF document to go with that for you to keep for future reference. So it's really easy to set up that. And to be honest, the income goes into a company, not your name. So it does indeed save you a lot of tax. I won't be able to go into it too much detail because this webinar is not really about limited companies. There's plenty of videos I've done, so feel free to go through Alex and anyone else listening to our channel to find other videos that I've done on that subject. Rose asked a question, as a British citizen temporarily living abroad for a few years, I'm looking to buy another property in the UK. What's the best option for someone like myself? And it's a great question. I often say that it's a good idea to buy property in a limited company wherever you live. I live in Spain, and any future investments I'll make in Spain will be in a limited company. I have a business in the US. Again, I have a business limited company as well in the US and the UK, same thing. And the reason why I say that is because a lot of countries are now going towards global taxation. If you have assets in your own name, then you could be subject to worldwide taxation in the country you're living in. So those assets, such as property in the UK or other countries, could be taxed in the country that you're living in because it's in your name. But if the assets are stored in the UK in a limited company and you live like I am in Spain, then the profits from that company won't be touched in Spain. It's only going to be taxed if I take money from the limited company. So it's a great way, to be fair, of international tax planning. And that's why I created this other channel, by the way, for international tax. So for you, Ro, you definitely need to look at that channel and subscribe to it and just look what I'm talking about there. Again, nothing too clever or elaborate, but it certainly can help you. It would be my second property for me to live in. Oh, right, and for you to live in. So my current one is a buy-to-let, and I'm abroad for now. Oh, right. So that's a bigger question, and you probably need to get some tax advice on that, only because we need to know what your current situation is. We're not going to get it from here, by the way, but we need to know what country you're living in, what tax position you're in that country, when you're coming back to the UK, how you become resident. It's a lot of detail. So please, please, please do get some tax advice, whether it's through us or someone else. But you definitely need to do that. So nice little question set there. Let's move on to the next subject, which is tax on rental income. There you go. Talk about name versus company, right? There you go. It's as though I planned this. So let's have a look at this. So one thing we need to think about here is if you have a property in your own name and that's the only source of income, you do have a personal allowance of 12,570. And if you're a couple, you could double that up, which means that the income from your properties, if that's all you've got, would be tax-free. But in a company, you don't get a tax-free allowance. There is no band there. It's all going to be taxed on the profits you make. And what I've done in here, I've just noticed there's a missing digit there. I do apologize for that. So there is a 20% tax rate, which it should say £50,270, by the way. But if you think about £50,000, that's why I used to look at it anyway. But that's 50,270. Do you know what? I'm sure I could just help myself out with the naughty boy school error. And there we go. I checked these slides as well. There you go. All right. So now just red pen from a teacher there. Old school, because they're not allowed to use red pens anymore. It's meant to be green pens. So move on. So company-wise, if you've got profits of up to £50,000, you're taxed at 19%, which is slightly less than the 20% tax in your own name, of course. It gets better though, because of course, when you go to profits of £125,000 from £50,270 to £125,140, you're taxed in your own name at 40%. So that's a big different tax change. Compared to a company, there is a weird number, and I'm not going to go into it in this video, where there is a marginal relief, and any profits over £50,000 to £250,000 is charged at 26.5%. And I know, it just sounds really bizarre, but when you do the calculation, it works every single time. So there is a marginal tax relief at 26.5%, so it does go up from 19%. That's a relatively recent tax change, I'll say a couple of years ago now. And then when for additional rate taxpayers earning more than £125,141, you're into the 45% tax band as an individual. But then the company at £250,000 would be subject to 25% tax. So using a company can certainly save you tax. Now, one thing I would say straight away, of course, is you will pay income tax on the dividends that you take out of a limited company. What the Labour Party will do with that, by the way, is another thing altogether. We do need to watch out for that space until sort of October. One of the things that you don't get in your own name is the ability to offset the entirety of your mortgage interest as a cost against your rental income, which means that the government ignores mortgage interest cost and then taxes you on the profit. They do give you a 20% tax reducer. It's the theft for me, by the way. How on earth that George Osborne introduced this as a Conservatives, that was their downfall. I think once they started doing that kind of thing, attacking the wealthy, which is totally against what the Conservatives used to be about, then I think that's when they started that slippery slope pretty quickly to their dismal performance of late. By the way, I'm not here to say I'm a voter of Labour Party Conservatives. I think, pardon my French, they're all crap. So don't come to me and say, oh, you're a Conservative, blah, blah, blah. I'm not. They're all bloody useless. But what I'm going to say to you is that when the Conservative Party brought in Section 24 mortgage interest relief cap, it really hurt a lot of landlords with properties in their own name, because it doesn't affect, of course, a limited company. No personal allowance in a company, which is one of their downsides. And then using a limited company, you do have extra administration fees, such as setting up the company, running the company, doing accounts, which is a lot more rigorous than just doing a self-assessment tax return. So accountancy fees do go up. And this is where most people say, oh, you're just trying to make money. Well, can I give you something and then I make something as well? I think that's what accountants are trying to do. You know, I know some people say, you're just trying to rip us off. I'm not saying that people are saying that about accountants generally, but I do hear that comment of saying, oh, you're just trying to make some money out of getting us to set up a company. Well, it's there and it does have a benefit. Whether you choose to use that is really, really up to you. No one's going to force you to do that, but you do need to look at the tax benefits of doing that kind of thing. So I want to just go through an example with you, just so you can understand how Section 24 affects you and how property tax is going to be there. Let's imagine you've got someone that's got employment income, so a high rate taxpayer. They've got property profits of £20,000, and the tax status, of course, is a high rate taxpayer. And the reason why I'm going to focus on the high rate taxpayer is because Section 24 really only affects high rate taxpayers. Section 24, if you're a basic rate taxpayer, doesn't affect you because there is a 20% tax reducer based on the mortgage interest, which is 20% as a basic rate taxpayer anyway. What have you lost? Nothing, in all honesty. So a lot of people, when you read the press and you say Section 24 with the end of landlords, I think that's a stretch because the whole thing about Section 24, it only affects high rate taxpayers. There's a lot more basic rate taxpayers with property than there are high rate taxpayers. So I don't think it's going to affect basic rate taxpayers. So you can almost switch off for this point of the video. Let's have a look how it affects anyway. So this is allowable cost to reduce property profits. Services provided to your letting. So we've got to now think about, well, what's allowable? How can I reduce my property profits? And some of these things are pretty obvious, but some of them aren't. And I'm going to explain why in a second. Services provided to letting agents, professional services, accountancy fees, consulting, if you've got the consulting helping you with your property business, that would also be allowed. Mortgage interest, again, 20% in your own name. I have seen some disasters actually, recent times, whereby accountants have ignored mortgage interest altogether and not even given a 20% tax reducer on the mortgage interest. Right, that's not the purpose of Section 24 at all. So why that's been ignored, I don't know. So please do check your tax returns very carefully from your accountant whenever they produce it for you. Repairs, replacement, renewals, like for like. If you're, and again, I do see a lot of errors from accountants that are general in nature. So I got ticklish nose. Apologies. So repairs, replace, renewals. The mistakes I see is that people will put in a fee for £20,000 as a refurbishment cost against one of their properties, and the general accountant nature would be, well, that's high, so I'll capitalize the whole amount, which means I'll put it against the balance sheet. It'd be useful for when you sell the property, but you can't have it against your revenue. And that's total rubbish, because if the property is in a lettable state when you bought it, which, by the way, if you've got a buy-to-let mortgage, one of the conditions is that it's in a lettable condition. So if you have a buy-to-let mortgage, ergo, it's in a lettable state, and you then buy a replacement kitchen, and it's a like-for-like replacement, as in it's got cupboards the same size, kind of nature. Yes, it's new and modern and clean looking, but actually you're not putting in 50 cabinets as opposed to the current 10, then that would be allowed. So replacements such as bathrooms, kitchens, is something I used to do on every property. I used to try and add a little bit of value, but I would actually do it to increase my rent. So the current properties I used to buy in Nottingham, they would be always in a lettable state. I could let it out, and maybe at the time, maybe get rent of £400 or £500. But then if I do it up nicely, I can get £600-700. That's the idea. So that's why it's a revenue cost, and it should be offset against your property income, which reduces property profits and therefore tax. And I used to do that I used to buy a property, funny enough, maybe 1, 2, 3 properties a year, just for the purpose of carrying forward losses, because I didn't want to pay tax on it. So therefore, I got rid of it. Eventually, I ended up incorporating my properties, which, by the way, I am not going to be talking about that on this show. Incorporation of properties is a whole bag of issues right now, thanks to Dan Needle attacking less tax for landlords and Property 118 and other firms out there. So we are waiting HMRC to talk about incorporation of properties. So please don't come onto the show asking about that. It's something I've put on my website to say we're not advising on that situation until HMRC make a decision. So incorporation is not a subject I'm going to be covering off. Coming back to this though, it is, repairs, replace, renewals, helps me save tax for about 8 years on my property profits. Really effective. Utilities, council tax and phone costs, of course. But again, what people miss out on is some of the things that they'll be using, like laptops, phones to call letting agents, stuff like that. They could put through as a business expense simply because they're using it for business. And use of home. You can put in a small amount. We're not talking about thousands here. We put in about £312 a year from our clients. Again, big deal, right? But every little helps, as one supermarkets might say. Travel. So again, travel, one of the biggest expenses I do see people miss out on is travel, going to see a property, travel, going to see a letting agent, travel, going to see an estate agent, travel, go to a network event for property investors. And it's a missed opportunity because the travel costs can be offset against your property profits. And if you keep a mileage log, it's 40 pence per mile. And it could, sorry, is it 45 pence? My brain's gone numb. But it's an allowance. I know, I just need to look it up. For whatever reason, my mind's gone completely blank on mileage allowance. But you can get a mileage allowance to reduce your property profits. You just need to keep a log of where you've been to, how many miles, what date, and if you've got an agenda or tickets that you're for an event, then of course you can put those expenses through. I don't see enough clients doing that, to be honest. And you can easily save a lot of money by putting travel costs in there. Travel subsistence. If you're going to see a property for quite some time, let's say that you're going to see 5, 6 properties, and you happen to buy yourself a reasonable lunch, a drink, sandwiches, something like that, for maybe 6, 10, 12 pounds. I don't know what the cost of living in the UK is now, but I've heard it's quite high. Crazy, isn't it? That before you could easily buy those packages, sandwich, food and drinks for maybe 5, 6 pounds, but now you'd be looking at me gone out thinking, well, that's more like 12. But anyway, you can expense that kind of thing against your property profits. So again, these are all allowable costs, and you should be able to put those in your accounts. And this is the kind of thing I'm talking about. So I would often do property refurbishments, which you can see the brown furniture is all going, and it's going to be replaced with the white, and that's a replacement kitchen. So all of that is allowable, but most accountants will try and say this is capital in nature. It's rubbish. It is totally allowable. It's on HMRC's reference about replace. By the way, the 3 R's, the repair, replace, renew, actually came from HMRC. I actually like the sound of it. So I'll put it as 3 R's, which is quite a nice marketing term. But if it's on HMRC's manual list, then it's got to be allowable. And most accountants don't read up on that kind of thing. Okay, so like-for-like replacements, it can go for revenue. If it's not like-for-like, so let's imagine that you're buying a property and you're converting it into a HMO. HMO is houses of multiple occupation. That is whereby you've got multiple people living in the same property. That's not related. So it's not a family, it's professionals or students. And the idea behind it is that you need bigger kitchen. Therefore, it's not like for like, it will be capital in nature. So if you're knocking in new bedrooms, for instance, going into the attic, that all will be capital costs. It will help you reduce capital gains tax, by the way. Receipts, keep them. You know, again, one of the big mistakes, and I'll talk about this very moment as well later on, is keep your receipts for everything you do, including your own home. Why? Because at some point, you might choose where you live right now to move out of that home, and then you'll rent it out. Eventually, you might even sell it. Now, if you sell it, you could use the cost of refurbishing that property, upscaling the property as a capital cost, but most people don't keep the receipts and therefore cannot offset those costs against capital gains tax. So it's a missed opportunity. So whatever you're doing in life, keep your receipts, keep them in box files. Louise, my wife, does a brilliant job of this, and it's really, really important for you to do the same. Okay, so I did talk about example. I kind of drawn this out, but I wanted to give you as much examples as possible. So this is rental profits of £25,000 in your name versus a company. Property costs of £10,000, mortgage interest costs, and then that gives you a profit of £5,000. No difference, is there? Well, there is really. And that's because we got the profit line. Let's start with that. So we're going backwards now, profit, but we've got to add back the mortgage interest costs for properties in your own name. In a company, you're allowed those mortgage interest costs. We're not adding anything back. But in your name, you're not allowed it. So therefore, the taxable profit is £15,000 in your own name. Fictitious, not real. Paper-based profits, not real profits. In a company, £5,000 is £5,000. That stays the same. So we now got to take the taxable profits of £15,000 and 5,000, tax at 40%. Well, we did talk about high rate taxpayers. Your tax bill is £6,000 compared to 19% of £950. 20% tax reducer. Don't forget, you do get a tax reducer for mortgage interest costs. So there's £2,000 back. And therefore, you've got a net tax of £4,000 versus £950. So where do you save tax? Well, clearly in a limited company. It's a no-brainer, really. And people say, well, I'm a basic rate taxpayer. Should I still buy property in a limited company? And my answer is yes, because surely one of your strategies is to build income. Well, at some point, you will move from being a basic rate taxpayer to high rate taxpayer. That is the idea of wealth generation, isn't it? So don't think about where you are just currently. You do need to think about what you're going to be going to. And that journey does involve a limited company in most cases. The one thing I want to bring to your attention is this bit here. Look how much tax this person is paying on the profits. We've got to remember the profits was £5,000, but they got £4,000 tax bill. It's 80%. So they're left with 20%. So who's making the most money? HMRC and the banks, no one else. You're not, as a landlord, by keeping properties in your own name. And again, this doesn't affect basic rate taxpayers, but again, you might move to being a high rate taxpayer. How do you save tax on rental income? I just noticed my e's dropped off on the side there. Keep a track of income and costs and keep receipts. Now, one of the things I would say is landlords, I'm going to say this, and I mean it from not I'm trying to belittle anyone or trying to attack anyone in that kind of regard, but I do see landlords as being very excitable of buying properties. They go to network events, they meet people, they can have a conversation. It's quite sexy, it's quite interesting, it's, all encompassing. It's a lot more positive. And then they buy a property, and then what happens? They refurbish the property, they take all the photos, do it on Facebook, take photos of that, say, look, what a great job I've done. They're in Facebook groups or they're in the property mentorship, and they celebrate the success. And by the way, all applaud it, because it's not bloody easy to be a property investor. I know myself, and therefore, congratulations to anyone that's doing this themselves, because it's not easy work. However, and a big however, and people will say to me, oh, you're only saying this because you're an accountant. Yeah, that absolutely. But I make money, right? So learn from me. If you are a property investor, please do not allow your first property or your properties that you bought, 1, 2, 3, whereby you're buying 4, 5, 6. Don't let your first 3 properties kind of go into rack and ruin. Make sure you track the income. Make sure you track the costs. Understand where you're making return on investment. Understand what is happening in that property. Is it being degraded in value because of misuse and you need to repair that property, or you need a new tenant because rent increases go up? These are all things that you need to consider. But I've got to be honest with you, hand on heart, and this is going to go against my own clients as well as other people out there as well. And therefore, I don't want to sound patronizing in any way. But there's not many people doing this. There's not many people doing this, whereby they're tracking by property, income and expenditure, making things are on track, that if costs going up, that they've got some sort of catch-all to reduce those costs, mortgage interest, utilities, keeping on top of that, council tax. Is this right? Can I challenge it? Doesn't happen. They just get onto the next property. The first 3 properties are going down in terms of return on investment, and then they keep hunkering on with properties 4, 5, 6, 7, 8, and the portfolio on the whole isn't really being maintained. Okay. Sorry about that. So see if a company is best for you. Of course, we talked about a limited company. I think most times it would be. Buy properties needing TLC. One of the biggest things I used to do is buy properties that are from the older generation, downsizing. So the children have all left home. They probably haven't maintained their property. They want to get rid of it, and they know things are wrong with the property. So I would often go buy properties that just need that upgrading. because I wasn't then competing against first-time home buyers that want something pretty decent. I was quite happy to buy properties that needed 10 and 11 care, and I could buy the property below market value and then make some more money on that. Buy commercial over residential. Again, whether you want to buy commercial properties, warehouses, that kind of thing, rather than just residential. Again, when I look at my own clients list, most people are buying residential, but actually there's a lot of money in buying commercial, and it's a missed opportunity. Track return on investment with or without a mortgage payoff. One of the things that's happening right now is mortgage interest rates are going up. And people say to me, oh, should I pay off my mortgage or should I buy another property? And right now, I would say if you're paying off your mortgage, which has got an interest rate of maybe 5-6%, you are not going to be getting that rate of return from your property for maybe the first 2 years, because you've got to buy the property, you've got to refurbish it, you've got to get it tenanted. That's going to take some time, especially nowadays with the tradespeople being so expensive. So I'm saying to clients, look, you should really look at your mortgages. And whilst mortgage interest rates are going so high, you need to try and pay those off. When interest rates are low, that's when you use banks and leverage your property portfolio. But we're in a situation now, in my opinion, that mortgage interest rates are high. You should pay those off rather than keep buying new properties, because it's just, especially with Section 24 mortgage interest relief cap in your own name, that's a great strategy. Just pay off your mortgage. And people will say, but I'm going to be paying more tax. Well, yes, but you'll be paying 40% tax maximum as a high rate taxpayer, not 80%, as I shown you earlier. So do think about that as you look at your own strategies. And again, if you go to our channel, www.optimizeaccountants.co.uk, we have created a UK property rental income tax calculator. There's also another one next to it, inheritance tax calculator, which is going to be quite interesting for a lot of people out there. So feel free to use that. I appreciate I'm going to be going over time. So I'm sorry for that, but I do believe in giving value as much as possible. So I didn't time this too well, but I'm hoping that you find it useful. And if you do, by the way, give this video a nice thumbs up, because that just shows that I'm doing the right thing for you guys. Okay, I'm going to do questions because we'll talk about capital gains tax later on. Let's get to some Q&A first, though. Let's see if there's anything in here. So this is a question from Lisa. I declared income on property that was bought from sale of my home before I married. As I was off work, I declared income, but the new flat I put in joint names, so both could get clobbered. We did tell HMRC. Yeah, I mean, that kind of thing, Lisa, is an opportunity to look at, and I didn't put that in my rental. Did I talk about it in terms of how to reduce tax? Maybe not. I'll come back onto that. The one thing I would say is people don't look at their tax strategy because they think, well, I'm just a landlord. There's not much tax to be saved. Wrong. In fact, you should look at all your income streams, because if you're someone who's a high rate taxpayer or married to someone who's a high rate taxpayer, what you want to be doing is saying, well, actually, any income that high rate taxpayer has got, you want to try and transition it to the basic rate taxpayer. And you could do that through different legal documentation. So for property, for instance, you would need a deed of trust. You would also need a Form 17. So don't do this on your own. If the property is 50-50 owned, do work with a specialist. And again, whenever you hear me say, oh, work with a specialist, it's something should be triggering off. Oh, he's trying to make some money. Again, if I can help you save some money, then is it okay if we make some money? That's fair, right? But I think one thing I would say is that a deed of trust helping out a couple whereby they are being attacked, even bank interest, dividends, shares, could be allocated back to the basic rate taxpayer as part of the more holistic tax strategy. Again, it's not just about property tax here. It's talking about all forms of income that a couple are making and how it should be allocated between that spousal couple to see where taxes may be reduced. And again, one of the things I did was, rather than buy stocks and shares in my name, I actually bought them in a limited company because I knew that I could save tax on those interests. Now, there are other things you could do, of course, such as ISAs and stuff like that. But what I'm really telling you is that tax strategy is not often that simple. And without talking to someone, you could do a number of you on yourself. I'm sure we've all been through that. I do a number of myself when I'm looking at my business and strategy, marketing, and whatever. And you don't have someone independent checking it, you kind of miss opportunities because you're so narrowed focused. That's my own issues with my own business, by the way. I openly admit that. But people will do the same with tax as well. So please do get some tax strategy there, Lisa. That'll be my advice. All right, capital gains tax, selling property. I did say that capital gains tax could be changed. So if that does happen, a lot of these slides might be thrown away. I thought I suspect it will be. Let's have a look though what we have got. Our slides aren't working so well. Okay, so capital gains tax. And again, I'm talking about capital gains tax in your own name. So if you've got sales proceeds, and you'll notice I see net. When people do capital gains tax calculation themselves, I see a lot of mistakes, and I will cover that off a little later on. So when you are selling property, capital gains tax is based on the sales price less the property purchase price and capital costs. Remember what I said earlier, when an accountant says to you that there's an element of cost that is capital in nature, that is added to the purchase cost to reduce your sales profit on that property. So don't forget it. A lot of people when I do a tax consultation, I'll say, well, have you ever refurbished the property which you've not claimed the cost against your self-assessment? And they'll say, oh, I did. There's £20,000. And it's like, oh gosh, £20,000 of cost will save you a lot of tax. Let's get that. Let's get all the receipts and add it in so we can legitimately, note that word, I'm not telling you to use some offshore loan account or offshore bank account to evade tax, which is illegal, by the way. I'm talking about legally avoiding tax by doing simple stuff. So taxable, £0 or £100,000, and I put taxable because you may have losses that you can carry forward, or it could be £100,000. Okay, so again, if the reach weight is 0, you may have losses for brought forward. You may also have a property or stocks and shares that you could sell off that will make a loss. That brings that £100,000 profit of this current asset, the house, down to 0. Again, working with a specialist can really help you save some taxation on that. What you pay capital gains tax on. So one of the things that you do need to think about is, have you ever lived in the property? And again, when people do capital gains tax and they have a home and then they move out of that home and then have it as a buy-to-let, eventually they might sell it. But the big thing is that they need to understand that the time that they lived in the property, they will get 100% tax relief because they lived in the property. It'll be their home. You don't pay capital gains tax currently. We don't know what Labour might do with that. But you don't pay capital gains tax in the time that you lived in the property. You also get an additional 9 months. Now, again, there are some really clever stuff in the legislation. I'm not talking about something, oh, Simon says this and it's not in the legislation. No. All the things I'm saying is in legislation. But did you know that you could, and I think Roe talked about this, whereby left the country, goes back, and maybe left the country for work purposes, got a job in a different country, comes back to the UK, back into the home, and then a year later, sell the property. Is the capital gains tax? No. Why? Because they've got an additional allowance, not just 9 months. So there are, again, clever ways of reducing CGT on properties that you've lived in. And as I said before, you got the time you lived in the property plus 9 months. Different circumstances may be more than 9 months, but let's stick to the basics here. Anything after that would be time basis, and then you pay CGT. So this is a home, you rented it out, there could be CGT on that property. Of course, if you've got a buy-to-let property that you're selling, then you pay capital gains tax on the full amount. And again, one of the things that people should look at is the capital gains tax exemptions on residential and non-residential, because again, if you've got a current property, it's just in your name, you might, if you're looking to sell it at some point in the future, you might miss out on the £3,000 exemption. A transfer of property between husband, wife, civil partner is CGT free. There might be some stamp duty. You have to watch out for that, but get some tax advice on that. But generally, no capital gains tax, and you could avoid stamp duty, land tax as well. It's not a trick. It's just that you have to tick a few boxes, and that's totally fine. But again, if you sell the property later on, something I do see quite often is we have tax consultations where people say, "Oh, we've just sold the property. Oh, just sold it. If only you held off, had a conversation with us, we could have saved you some tax on that straight away. Maybe at least £600, for example." And yeah, so £3,000. And then what you have is a basic rate taxpayer. So this is correct. Look, now I got the 270 correct. Capital gains tax is a basic rate taxpayer earning less than 250,271. You're a basic rate taxpayer. Selling residential property, you're going to be taxed at 18%. But look at that. Non-residential properties, you're only paying 10% capital gains tax, which is less, of course. Another good reason to buy commercial property. High rate taxpayers is taxed at 24%. It used to be 28%, but it has been reduced back down to 24%. And then for non-residential properties, you're paying 20% tax. Again, a bit of a discount there for buying and selling residential property over residential. So let's imagine you do have £100,000 gain, exemption £3,000, could be doubled up as a couple, as we talked about before. Net taxable, but then look at the tax as a higher rate taxpayer, 23,280 versus 19,400. So again, non-residential properties, you do save tax. And people say, well, is FHL, furnished holiday let or service accommodation, is that non-residential? And the answer is no, it's residential. So you have to do the right calculations for that. And again, coming back to the point of helping you save tax, this is my last slide kind of on this capital gains tax now. And keep track of all purchases and sales costs, error of omission. If you don't have receipts for something, then you won't be able to claim the costs. The other side to that is completion statements are very, very valuable. I do see a lot of mistakes when people are doing their capital gains tax calculations because they ignore the purchase stamp duty land tax, they ignore the conveyancing costs, and ignore any other costs and search fees and so on like that. They just said, "Oh, I bought it for 100,000," and then they put the 100,000 as a cost, or "I bought it for £500,000," and then just put £500,000 as a cost, ignoring stamp duty land tax, ignoring legal costs, which are genuine costs to help you reduce tax. It's a total omission. And capital costs, of course, if you have not expensed capital costs against your self-assessment tax return, then you can use that refurbishment cost against your capital gains tax bill and save money. And again, use tax planning. Look at ways of reducing CGT. By the way, I'm not talking about properties being 50-50 either, because you could be in a situation, we've had some crazy numbers, okay? So I've seen calculations where we've allocated 73% to one partner and the remainder against the other partner. Why? Because we want to identify the CGT annual allowance, but then we want to hit the sweet spot into the taxable earnings. So we allocate different percentages to the spouses, and it works out into the saving tax. So there you go. Sell loss-making assets to offset the gain, which, as I talked about earlier, it could be zero or it could be £100,000. Remember that slide, whereby you make £100,000 gain on property, but if you had losses on selling other properties or stocks and shares, then that can help you to reduce your capital gains tax. So loss-making assets could really help you out. You want to get rid of those assets anyway sometimes, so that could be an opportunity. Sell in different years when you earn the least. One of the things that I'm helping quite a few clients is understanding about leaving the UK and then selling properties at a later date. That can work against you though, so you do need to be careful on that. So it's not the simple case of, oh, I've heard about NRCGT where I can use my 2016 valuation, 2015 valuation, and it will help me tax and blah, blah, blah. But then they move to a country like Spain, and they will tax you on the full amount. So you're almost reducing tax in one country, but then getting clobbered in another country. for taxation. So you do need to get some tax advice. I can help you with Spain, of course, because I live here. But I can also help you with UK, US, and Spanish tax. So when it comes to strategizing what you do next, I can certainly help you with that. Invest money into pensions, extend your basic rate tax band. Again, one of the things that you could do is lower your earnings by putting money into your pension, which extends your basic rate tax band, which means you pay less tax. And of course, we do have a capital gains tax calculator. So make sure that you utilize that capital gains tax, understand how much money you're going to be paying, and then book a call with us, preferably before you actually sell it, because there's not, for us to be proactive, we need to be to have a situation we can change. If you've sold the property already, it's then going to be a simple calculation. By the way, if you're selling residential property, then you do need to report it within 60 days of sale. So that's another thing that we're seeing a lot of landlords miss, and they are then going to get penalized for not doing the reporting to HMRC. All right, so let's have a look at some questions then. And again, guys, if you find this interesting, please do give us a thumbs up. I see there's 7, 8 maybe likes. So let's get to double digits on the likes. That'd be really helpful, just because it just promotes the video, hopefully gets it out there on the YouTube algorithm. Really does help out. So hopefully if you're enjoying this free content, getting something out of it, give me that thumbs up. That'd be really appreciated. Thank you. I don't want to be begging, but I'm sounding like I am. Okay, no questions. Wow, you're a quiet bunch tonight. That's surprising. Okay, hopefully I might get some more questions in a second. Oh yeah, actually that brings me to a close. So there you go. I'm hopefully not over too much. I am over, so apologies for that. But if you've got any questions, I'm happy to just kind of see. I'm just going to have a look, see if there's anything else. I don't think there's anything there yet. So if it's okay with you, I might go watch Liverpool. No, that's it straight away. Everyone switched off. I might go watch Liverpool play in the Champions League. So thank you ever so much for joining me tonight. This will be on YouTube, so you can rewatch this at any point in time, by the way. So feel free to go back and watch this on our channel. Subscribe to our other channels as well. And that then brings me to a close. So thank you ever so much for being with me tonight. Hopefully you enjoyed it, and I shall see you all again soon. Have a great